The markets have been through a storm in the past few weeks. We have seen sharp corrections, panic selling, and a general sense of unease. And now we are seeing some relief. But is the bloodbath really over, or is this just a temporary bounce before another drop? Let's break it down. The biggest shock to global markets came from Trump's announcement of new tariffs on Chinese electric vehicles, batteries, and medical products. The new 100% tariff on Chinese EVs, up from 25%, is aimed at protecting US manufacturers, but it is also a clear sign that the trade war narrative is not going away. Markets initially shrugged off the news, but historically, tariff escalations tend to have a delayed impact. In 2018, when Trump imposed tariffs on China goods, markets corrected sharply after an initial period of complacency. The bigger concern is retaliation. China has already hinted at countermeasures, and if they target critical US exports, we could see earnings estimates for multinational companies getting revised downwards. That, combined with existing supply chain pressures, could create another wave of market volatility. The new tax code, complete nothing burger as far as the markets are concerned, no major impact, no major reaction. Moving on. On the monetary policy front, the RBI announced a 25 basis point rate cut, bringing the repo rate down to 6.25%. This move was widely expected given the slowdown in credit demand and weakening industrial production. While lower interest rates should in theory be a positive for the markets, the bigger concern is why the RBI felt the need to cut rates in the first place. Growth momentum has slowed, and even though inflation has come down, consumer demand remains uneven. The latest CPI numbers suggest that inflation is cooling, with headline CPI falling to 4.3% from 4.9% last month. Food inflation, however, remains sticky, with vegetable prices up 7.2% over the year. The bond market's reaction has been mixed. While yields have softened, traders aren't fully convinced that this downtrend will last. If we see any fresh supply chain disruptions or energy price spikes, inflation could re-accelerate, forcing central banks to rethink their stance. So, is the bloodbath over? Maybe, but if history has taught us anything, it is that bear markets don't resolve in a single day. Every major correction sees relief rallies, short bursts of optimism before the market finds a true bottom. Liquidity remains tight, corporate earnings have yet to fully reflect the macroeconomic stress, and geopolitical risks are still elevated. It wouldn't be surprising to see another wave of selling before real stability returns. I remain bullish on a few key themes: assets that tend to hold value in certain uncertain times, and businesses that have strong fundamentals. Gold continues to be a hedge against macro uncertainty. The USD remains strong as capital flows into safer assets. Large consumer names with pricing power are still attractive, and some banks are available at valuations that make sense. But this is not the time to chase. It is a time to position carefully, wait for confirmation, and avoid unnecessary risk. The easy money days are over. This is a market that demands patience, strategy, and discipline. If you want to stay updated on market trends, join the Telegram group and hit subscribe. I'll keep sharing insights to help you navigate these volatile times. Stay sharp, stay prepared, and I'll see you in the next one.